Okay, so we'll go ahead and get started on the PowerPoint presentation. This is starting a new business to-do list. Things I'm going to be talking about today are business structure and entity selection, what would be best for your new business, choosing your business name and getting licensed with your state, obtaining an employer identification number from the IRS, talk about different accounting methods, cash versus accrual, talk about record keeping and bookkeeping, what the difference is between a business and a hobby in the eyes of the IRS, talk about different types of business taxes, and also we'll talk about what it will mean to add an employee to your business as far as record keeping and taxes. So the first thing I want to talk about is business structure and entity selection. So when you're starting a new business, one of the first things you need to think about is choosing what kind of entity your business is going to be. So you have the following choices for entity selection. You can be a sole proprietor, an LLC, a partnership, a C corporation, or an S corporation. So the easiest entity to set up would just be the sole proprietor. All you have to do is get a business license and you're good to go. There's no separate tax reporting needed. For tax purposes, you'll just file an additional page or two with your personal Form 1040, the Schedule C. So while it's easiest to set up, there's also the drawback of all of your profits being subject to self-employment tax, which is 15.3%. For the LLC, the LLC is a disregarded entity in the eyes of the IRS, so you will either be taxed as a sole proprietor if you're a single member LLC, or as a partnership if you're a multi-member LLC. You can also make an election to be taxed as an S corporation, which we'll talk about in a little bit. So if you're a single member LLC and you don't make the S corporation election, you're simply going to be taxed as a sole proprietor for tax purposes. It'll be, again, on the Schedule C as part of your Form 1040, and all your profits will be subject to that self-employment tax. If you're a multi-member LLC and you have not made an S corporation election, then you'll be taxed as a partnership, which I'll talk about in just a second. And also, again, if you make that special S election, then you will be taxed as an S corporation. So it's a partnership. It's when there are two or more owners sharing in the profits and losses, or if you're a multi-member LLC. There's no tax at the partnership level, so partnership is a flow-through entity. So if you are a partnership or a multi-member LLC, you will need to file a separate tax return, Form 1065. However, again, there's no tax at the partnership level. So you will receive a K-1 from that Form 1065, and you will record that income on your Form 1040. So each partner will get a K-1, and then you'll be taxed at the personal level. And again, all the income from a partnership is going to be subject to that 15.3% self-employment tax, unless you are a passive member of an LLC, in which case you may not be subject to self-employment tax. So next there's the C corporation, which is just a regular corporation. When people talk about double taxation, they're talking about a C corporation. Basically, with a C corporation, you have a separate tax return that you do need to file, and you will pay tax at the corporate level. And if you make any dividend distributions to the owners will again pay tax on those dividends on the personal level. So that's what people are talking about when they talk about double taxation, because a C corporation is subject to tax at the corporate level, and any dividends are taxed at the personal level. Last, there's the S corporation, which I was talking about earlier. That with the S corporation, you avoid that double taxation of the C corporation, and you can also potentially save on self-employment tax. Like the partnership, an S corporation is a flow-through entity, so there's no tax at the corporate level. You'll be taxed at the personal level. That's how you avoid that double taxation. There's no tax at the corporate level. And when we talk about saving on self-employment tax, basically the entire S corporation, the net income that you report on your personal taxes is not subject to the self-employment tax. However, with an S corporation, you are required as an owner to pay yourself a reasonable wage. So let's say your S corporation is looking like it's going to have a net income of $100,000 for the year. Out of that $100,000, you are required to pay yourself a reasonable wage. So let's say you decide your reasonable wage is $50,000 for the year. You take $50,000 out of the salary, now you're left with a net income of $50,000. And you want to take that money out of the corporation to use personally, you can take that $50,000 out as draws to yourself, and it will not be subject to Social Security and Medicare tax. So that's how you can potentially save on self-employment tax as an S corporation. So this is just a quick overview of the different entities that you can choose from when setting up your business. For more information on entity selection, a lot more detail, I encourage you to sign up for John Huddleston's webcast entitled LLCs and S Corporations Explained, Using Them to Reduce Taxes. You can sign up for that at smallbusinesswebcast.com. He goes into a lot more detail about the different entities and about how S corporations can potentially save you money. And one other note I forgot, at the end of this presentation, we will be emailing you a copy of all of these slides. So if you came in late and didn't get all this, or can't take notes fast enough or whatever, we will be emailing you a copy of all these slides. So let's see, in the chat, Dennis is asking, if you are an LLC and elect to be taxed as an S corporation, do you still have the same requirements as an S corporation? For example, corporate minutes, an annual meeting, etc. So that's a good question. I know, so if you are an LLC and you are taxed as an S corporation, then you have to file the S corporation tax return. But it's just a tax election. So I'm not sure that you're subject to the same requirements as far as corporate meetings, corporate minutes and annual meetings, since technically you're still an LLC. You're just being taxed as an S corporation. I could look into that further, but I'm pretty sure you're just subject to the rules for tax purposes. Okay. So the next thing I want to talk about is business name and state licensing. So when you're starting a new business, of course, you have to choose a name for your business, and you also have to get licensed with the state. So when you finally choose a business name, it is important to check on the state level to see if that name is already taken. You will have to file some sort of business license with your state, and if somebody already has that business name, you will not be able to use it. So for Washington State, I know not everyone here is from Washington, but that's the state that I do most of my work in. So when we set up a new business, the first thing we do is check with the Secretary of State to see if that name has already been taken. If it has, then you're going to have to choose a different name to get licensed with for the state. You'll also need to get a business license with the state. And again, requirements vary from state to state. So I would encourage you to visit your state's website, maybe Secretary of State, Department of Revenue, whatever the website is for your state, and to look up the specific licensing requirements. So I can speak for Washington State. If you are setting up a corporation or an LLC, you do need to get licensed with the Secretary of State. For any business, the sole proprietor, corporation, LLC, whatever you're setting up, for Washington State, you do need to file a master business license with the Department of Revenue. So it could be for your state that you just have to file one business license application and you're good to go, or there may be multiple agencies that you need to register with. So it is important to visit your state website or to contact a CPA to help you research the requirements to get set up. Once you've decided on your name and gotten registered with your state, you need to obtain an employer identification number with the IRS. So you also need to know, let's see here, there's a question in the chat really quick. So if incorporating in Delaware but operating in Washington, is the same licensing required in Washington. So if you are incorporated in another state, but you're doing business in Washington State, you need to get you need to still get licensed with the Secretary of State. You basically need to get a foreign corporation license so that they know that you are doing business in Washington State, because you will still be subject to things like Washington State B&O since you are operating in Washington State. So yeah, you need to check out with the Secretary of State getting set up as a foreign corporation doing business in Washington. Okay, so back to the employer identification number. Once you have decided what kind of entity you're going to be, what your name is, and gotten licensed with the state, you need to visit the irs.gov or in order to obtain your employer identification number. So EINs are required for corporations, partnerships, and any business that has employees. So if you're just a single member LLC or a sole proprietor and you do not have any employees, you do not need to obtain an employer identification number. But if you are a sole proprietor or a single member LLC and you have employees, then you will still need to get an employer identification number. So the way you can do that is you can go online to irs.gov and you use their online application. Their online employer identification number application, and you will, after you fill it all out, you'll instantly get your EIN and you can start working from there. Or you can print out the form SS4, fill it out on paper and send it into the IRS, and they will send you a letter in the mail with your EIN. If you're looking to get started right away or need an employer identification number right away, then I would definitely recommend using the online application because it is pretty instantaneous. So the next thing I want to talk about are different accounting methods. So when you're keeping your books and doing your tax return, you can either do it on the cash method or the accrual method of accounting. The cash method is the most commonly used by small businesses. Basically, when you're using the cash method, you don't recognize income until the cash is actually received, and you don't recognize expenses until the cash is actually paid out. So you might bill somebody with an invoice, say they owe you $1,000 for work done. However, until they pay you for that $1,000, you do not recognize that as income. So you might have done the work and they owe you that $1,000, but on the cash basis of accounting, you have zero income until they pay you. With the accrual method, you recognize income when a sale occurs, even if no cash has been received. So in that same example, if you've invoiced someone for $1,000 and you've done the work, it's like you've already made $1,000 in the business, even though you haven't received any cash. And it's the same with expenses. You recognize expenses when you receive the goods or services, even if you have not yet paid for them. So with the cash versus accrual methods, the advantages of the cash method are that you have a better picture of current cash on hand because you're not recognizing income or expenses until the cash actually changes hand. So the cash you have in your bank account, the cash you've paid in, the cash you've paid out, it's a much more accurate picture of how you're operating as far as money is concerned. It's also easier to maintain for bookkeeping because you're not having to keep accounts payable and accounts receivable records. Some disadvantages a disadvantage of the cash method is that you have a misleading picture of longer-term profitability. You don't know what's happening in the future. You don't necessarily know offhand what you've billed for, what money is going to be coming in. You know, you might have accounts receivable out there, but you're not keeping track of that on your books, so you might not have as good a long-term picture as you would with the accrual method. With the accrual method, the advantage of that is that you more accurately shows you a picture of how your business is doing because it shows the ebb and flow of income and debts. Disadvantage of the accrual method is that it can lead to cash flow problems because it does not show you an accurate picture of cash on hand. You might think that you've made you show on the accrual method that you've made $50,000, but maybe you've actually only received $10,000 of that in cash. So you don't have an accurate view of how much money you actually have on hand. Also, it can lead to more confusing bookkeeping because you have to keep track of accounts payable and accounts receivable, and it can get a little messy if you're not right on top of that bookkeeping. So finally, about the cash and accrual, most small business owners can choose to be cash or accrual, but there are times when the accrual method is required. So if you're a business that has sales of more than $5 million per year, or your business stocks an inventory of items that you will sell to the public and your gross receipts are over $1 million per year. In those two cases, you will be required to file your tax on the accrual method. But for most small businesses, they find that it is easiest to just go ahead and use the cash method. It's less confusing for bookkeeping. It's easier when it comes to tax time. And it's just the most, it just seems to come most naturally to most people when they're starting a new business. So talking about cash versus accrual methods of accounting leads kind of into record keeping. Keeping good records for your business is very important. I have a couple examples of ways to do your bookkeeping. You can keep Excel spreadsheets to keep track of your income and expenses. You can categorize them by different expenses like accounting, bank charges, professional fees, postage, etc. Or you can use Quickbooks. There are many other ways to keep your bookkeeping as well, but as an accountant, as a CPA, I'd recommend that you, at the minimum, use Excel spreadsheets. The best way, I think, would be to use Quickbooks. Quickbooks does a good job of walking you through how to keep your records straight, keep them in order, and it's easiest at tax time for your accountant just to be able to take your Quickbooks, look it over, make any adjustments that need to be made, and all of your income and expenses are nicely summarized in there. Basically, try to do something that doesn't involve a box of receipts. When you're keeping your books either in Excel spreadsheets or in Quickbooks, at any time you can kind of look at your books and get an accurate view of how your business is doing. If you're just keeping a pile of receipts or a box of receipts, you can't just figure out, you can't really figure out how you're doing as business. Are you making money? Are you losing money? You need to be able to have an accurate view of how things are going in order to correctly and successfully run a business. Another question that we get a lot is how long you should keep your records. Some people say 3 years, some people say 6, some people say forever. Basically, the IRS statute of limitations for audit is 3 years from the date that you filed your return or the date that it was due. So at a very, very minimum, you should keep your records for at least 3 years. If you are audited and the IRS is looking at those 3 years worth of records and they find that you've substantially understated or incorrectly stated your income or your expenses, they are able to go back 6 years to look at your records. If they find that you've committed any sort of fraud as far as your taxes, then they can go back as long as they want, forever. So basically, I would say that you should keep your records for a minimum of 6 years. However, in the new technology, it's very easy to scan your records and keep them electronically pretty much forever. So I definitely consider keeping the paper files for at least 3 years. And probably it would be a good idea to go ahead and scan somehow your records and keep them indefinitely. Again, the IRS also recommends for payroll records that you keep them for at least 4 years. And you should also remember that the burden of proof does fall on you. So if you are audited, the IRS looks to you to provide backup for all of your income and expenses. So better safe than sorry when it comes to keeping your records. Next thing I want to talk about is business versus hobby. So if you're starting a new business, in the eyes of the IRS, you're either a business or you have a hobby. So you do need to make sure that the business you've started for tax purposes is an actual business and can't be reclassified by the IRS as a hobby. In general, an activity qualifies as a business if it is operating with a reasonable expectation of making a profit. So if it's just if you have a full-time job and you just do some little business on the side that mostly loses money, and you're not really invested in working to grow as a business, it's a good possibility that the IRS would view that simply as a hobby rather than a business that you are operating and trying to make a profit at. This doesn't mean that you have to make a profit in order for your business to qualify as a business rather than a hobby. For the IRS, they say that if a business makes a profit during at least 3 of the last 5 years, it is considered to be a business. However, if your business, is operating 5, 6 years and you're still operating at a loss, it doesn't mean that the IRS is going to automatically say you have a hobby. If you are doing it full time, if you are trying to actively grow the business, if you are investing your time and your efforts in growing this business and trying to make a profit, you still might have a business. It might just be that you're having a rough start or that the economy is working against you. So don't automatically think that, oh, it's been 5 years and I haven't made any sort of profit yet, the IRS is going to start disallowing my losses. It's not necessarily the case. But we can talk about what happens if the IRS does deem it a hobby. Basically, if you have a business, it's going to show either on the Schedule C if you're a sole proprietor or on the Schedule E if you are a partnership or an S corporation. However, if the IRS decides that it's a hobby, the income must be shown on page 1 of the 1040, but corresponding deductions you're not able to take those on page 1. Those are taken as an itemized deduction on Schedule A. So if it is deemed a hobby, you don't get the full benefit of the deductions. So definitely make sure before you start claiming deductions and a business with a loss on your 1040 that you're actually running a business that's trying to grow, trying to make a profit, and has a reasonable expectation of making profits at some point in the future. Okay, so now I want to talk about business taxes. So you've been running your business, things are going great, and it's tax time. So you need to know what to file. So basically, for income taxes, your business will be required to file an annual federal tax return. So again, if you're a Schedule C, a sole proprietor, you'll file Schedule C on Form 1040. If you're a partnership, you'd be filing Form 1065. If you're a C corporation, you'd file Form 1120. And if you're an S corporation, you'd file Form 1120S. So that's going to be annual. For the 1120, the 1120S, those are both due on March 15th. For the 1040 and the 1065, those are due April 15th. So then there's also self-employment taxes. Sole proprietors and single-member LLCs are required to pay self-employment tax on their Form 1040 if their net earnings from self-employment exceed $400. So this is not a separate business or a separate tax return, but you do need to file the self-employment tax schedule with your 1040 if you have net earnings from your Schedule C for the year. Then there's employment taxes. So if you have employees, you will be required to file and pay quarterly and annual federal employment taxes. And I will be talking in more detail about employees in a minute. You also need to be aware of state taxes. So your state may have an annual income tax, and it may also have an excise or B&O tax, or you could have both. So for Washington State, we do not have a state income tax, so your business would not be subject to an annual income tax for the state. However, we do have excise tax return for businesses. Those are either filed annually, quarterly, or monthly. And when you register with the Department of Revenue, when you start your business, you will be notified by the Department of Revenue as to whether you are a monthly, annual, or quarterly filer. So there's no it is state by state as far as what the state requirements are for your business taxes. So again, it's a good idea to visit either the state website or to talk with the CPA. So now you've got your business running and you want to add some employees. So the first thing you need to figure out is, are you bringing on an employee or an independent contractor? If you hire an employee, then you are required to withhold payroll taxes for them, file an annual W-2, do everything that goes along with having an employee as far as taxes. If you hire someone and they are an independent contractor, then you simply make the payments to them for the work done and then send them a 1099 at the end of the year with their income. You're not required to withhold any payroll taxes or remit anything to the IRS for them other than that 1099 at the end of the year. So when it comes to employee versus an independent contractor, you need to think about behavioral control, financial control, and the type of relationship you have with them. So basically, if you want someone to come work for you, you only want them to work for you. You want them to work the hours that you are requiring of them. You provide them with the computer, you provide them with a place to work, and they follow the rules that you've set, and you tell them how to do their job. They're going to be an employee. If you hire someone to work here and there, maybe not on a regular basis, or you give them the flexibility to keep their own hours, they bring their own computer to work, they work maybe out of their home, and they're allowed to work for other people while still working for you, then chances are you have an independent contractor on your hands. So, some other things to think about is, do you direct how the work is done? Do you tell them how to get their job done, or do you simply expect the completed work at the end of when it's due? If you're telling them exactly how to do it step by step, that's going to be an employee. If you're simply telling them, here's what I need done, do it however you want, just get it done to me, just make sure it's done and get it to me, it could be that they are an independent contractor. And also, like I was talking about before, are they allowed to work for other companies? So if it's someone that's working for you and several other companies, they're filing their own taxes, maybe they have their own business, they have an employer identification number, that's going to be an independent contractor. If they're only allowed to work for you, if you have them sign an employment contract, anything like that, you have an employee. You need to withhold those payroll taxes. You need to pay the matching Social Security and Medicare. You have an employee on your hands. So when you have an employee and they are a W-2 employee, you must withhold Social Security and Medicare taxes and federal withholding. You must also match the Social Security and Medicare taxes and pay that to the IRS. You must file quarterly 941 taxes with the IRS. That's an informational return basically saying what the wages were for the quarter, what kind of Social Security and Medicare withholding there was, and what kind of federal withholding there was. You're also going to need to make most likely monthly or possibly monthly 941 tax deposits, or if you have several employees or your wages are pretty high, then you might have to file or pay the 941 taxes to the IRS within 3 days of paying the payroll. It depends on your payroll level, and you will be notified by the IRS of their requirements. So basically, you would register with EFTPS to remit those 941 deposits when they're required. And that's going to consist of the withheld Social Security Medicare from the employee, the federal withholding that you've withheld, and then your matching Social Security Medicare payments. You must also file an annual 940 tax return with the IRS. That's the federal unemployment tax. And you also may have state employment taxes as required. So for Washington State, you have to be registered with the Department of Labor and Industries and pay a quarterly L&I tax. And you also have to be registered with the state unemployment tax, and you will have to pay a quarterly state unemployment tax. So again, you need to look into the specific requirements for your state. Some other things to remember when hiring an employee: you need to make sure you set the compensation level and the pay dates. So that needs to be written down so the employee is very aware of what you're going to be paying them and when you're going to be paying them. You also need to discuss benefits, whether or not you'll give them paid vacation, sick pay, whether there's a retirement plan, etc. Needs to be a clear understanding when entering into an employment agreement. When you've hired the person, you need to have them fill out a W-4 so you know what kind of federal withholding to keep from their paycheck. And you need to make sure you're set up with the state to have employees. So for Washington State, when you file a master business license, you need to indicate at that time if you're going to have employees or not. So maybe you start a business and at the beginning you don't think you're going to have any employees, so you mark no employees. And then maybe a year or two later you decide, oh, I want to hire an employee. So for Washington State, you need to go back and refile that master business license to indicate that you will be having employees. And they will then get you registered and set up with the Department of Labor and Industries and the state unemployment tax. And then you also need to decide if you're going to be doing the payroll yourself or if you'll be hiring a payroll service to do it for you. If you're keeping your books in Quickbooks, all you have to do is activate the payroll module in there, which is an additional fee, but it does all the calculations for tax withholding for you. And then you'll need to remember to do your quarterly and annual tax returns. If you hire a payroll service, they'll take care of pretty much everything for you. You just send them the hours, set up, and give them the information on new employees. They send you the checks for every pay period, and they do those quarterly filings for you. So you need to decide how active you want to be in preparing that payroll. So that was everything I wanted to go over today. I know that was a lot of information, so hopefully it was clear. I'm going to try to unmute everybody, and if there's a lot of background noise, then I just might remute and have everybody ask questions in the chat. So let's see how it goes here. Does anybody have any questions?
Yeah, this is Dennis Thompson.
Uh-huh.
Do you hear me? My understanding is that the L&I department and the IRS is now sharing data on independent contractors. Have you heard that?
No, I haven't heard that, but it's, I'm sure it's quite possible. I know they're trying to crack down on employees versus independent contractors to make sure that they're getting the Social Security, Medicare taxes. But yeah, I have not directly heard that. I
was just thinking you'd want to be consistent in how you're reporting in terms of both IRS and state if you're doing that.
Right. Yes. Yeah. If you hire someone as an employee, make sure that you're reporting them to the IRS as an employee and to the state as an employee as well, so that if there is any sort of matching, that you are being consistent with your treatment of those employees. Okay. Are there any other questions? Again, we'll be emailing you all the slides you saw today, so if you think of any questions later, if you go over it again and you have any other questions, you can email me or give me a call. I'd be happy to go over that with you. Also, for anyone who came in late, make sure you're registered at smallbusinesswebcast.com so you're made aware of our future webcasts. And if you need any accounting help, feel free to visit our website at Huddleston Tax CPAs.com. And we have clients not just in Washington State, but all over the country and actually all over the world. So feel free to contact us if you need any help. Also, we'll be emailing you a tax review coupon. So basically, you can send us your last 3 years' tax returns. We'll go over them and see if you left any money on the table with the IRS. Our firm's record is $44,000, getting money back that people have left on the table. So we'd love to try and beat that. So yeah. Are there any other questions? Let's see. Richard, did you have a question? Let's see. Okay, looks like we have a question in the chat. If I choose to register a company as a parent company based, let's say in Nevada, and I register another one in Washington to operate under Washington laws, in the under the one in Nevada ownership, how would that affect me tax-wise? So if you're operating in Washington, then as far as where you're registered, it doesn't really have much effect on your IRS taxes. It would just have to do with the state taxes. So if you're registered in another state but you're operating in Washington, you're still going to need to pay the Washington state B&O tax. And then he also asked, do I need to hire a CPA in Nevada, one in Washington, or both? You only need one CPA, no matter where where your business is registered. They should be able to figure out the requirements for the states, no matter where they are. So yeah, if you're operating in Washington, you only need to have a CPA in Washington. That should be fine. So Jen's question is, can you talk about what needs to be filed if, as the owner, you're the only employee of the LLC filing as an S corporation? So if you are the sole owner of an S corporation or of an LLC filing as an S corporation, you do need to pay yourself that reasonable wage. So you'll still need to file the 941s, the 940 with the IRS. As far as the requirements for the state, it's going to vary by state. But for Washington, you're not subject to that labor and industries or the state unemployment tax. So you don't have to file the state employment taxes for Washington State. Now that might not be the case for other states. I don't know what state you're in, but so then Richard says that he was having trouble getting the program to work at first and missed the first 15 minutes. So I am recording the webcast, and it will be available on smallbusinesswebcast.com probably in a day or two if you need to watch the replay. So I think I got everybody's questions out of the chat. Did anybody have any other questions? I did mute everybody again because it was quite loud. And again, if I didn't answer your question or if you have questions that you think of afterwards, go ahead and send me an email and I'm happy to answer those questions for you. So if there are no other questions, then that was all I had for today. I thank you for attending and I hope you have a great rest of your day. So thank you, everybody.
Thanks, Jessica.
Thank you.